For the first time in 5 months, gold just closed out a winning month. Not a winning day, a winning month. If you've owned gold or silver through this year, you know exactly what the last few months have felt like. Red candle after red candle. Comment sections full of people asking, "Did I make a mistake?" And then, quietly, without a single headline screaming about it, the month flipped green. I'm going to show you exactly what changed, why it changed, and more importantly, what would have to happen next for this to actually mean something versus just being noise. Because here's the thing nobody tells you. Most people who lose money in gold and silver don't lose it because they were wrong about the metal. They lose it because they can't tell the difference between a real shift and a fake one. By the end of this video, you will be able to. I'm not here to hype you into anything. If you're expecting gold to the moon screaming, this isn't that video. Stick with me. This is the stuff that actually matters. Set the common belief. Here's what everyone thinks right now. Gold and silver had their moment in January. They've been bleeding out ever since, and the story is basically over for this cycle. That's the common read. It's not crazy. It's what the price chart looks like on the surface. But that read misses the one thing that actually explains everything that's happened this year and everything that just happened this past month. Once you see it, you'll never read a gold headline the same way again. Body point 1. What actually happened? Let's start with the facts, plainly. Gold is trading around $4,050 an ounce right now. Silver is sitting near $58. Both are well off their January peaks. Gold came within striking distance of $5,600. Silver briefly cleared $115. So yes, on paper, both metals have given back a big chunk of that run. But look at what happened in July specifically. Gold posted its first monthly gain in 5 months. Not a huge one, a couple of percent, but after 5 straight red months, a green one is a different animal. Silver held its ground near $58 through the same stretch, even after a rough June. Here's the but that matters. This didn't happen because some new gold discovery flooded the market, or because demand suddenly collapsed. It happened because of one specific mechanical shift. The market's expectations around interest rates moved, even slightly. And that one shift explains almost everything that's happened to these metals all year. Here's how. Body point 2. Why it moved. Gold and silver don't pay you interest. They just sit there. So when interest rates are high, and right now the Fed's benchmark rate is sitting at levels not seen in years, money has an easy, boring, safe place to go instead. Bonds and cash. That competition is the single biggest weight on precious metals in any given year, more than almost anything else people talk about. This year, that weight has been heavy. The Fed has held rates steady through several meetings, but every time officials signaled they might need to raise rates again to fight inflation, gold and silver took the hit. And there's been real reason for that concern. Renewed conflict involving Iran pushed oil prices higher earlier this year, and higher oil feeds straight into inflation numbers. But at the most recent Fed meeting, something notable happened. The Fed held rates steady again. And while a few officials pushed back and said more tightening is still needed, the broader market reaction was that the odds of another hike didn't move as sharply higher as they had after prior meetings. That small easing in rate hike expectations is the hand loosening that let gold and silver breathe in July. That's it. That's the mechanism. Not a secret, not a conspiracy. Just less fear of higher rates equals less pressure on metals that pay no yield. And here's why that one detail should change how you look at this entire year. If the only thing pushing gold and silver down was rate hike fear, not some flaw in the actual case for owning them, then the moment that fear eases even slightly, you'd expect exactly what just happened. A bounce. The underlying reasons people buy gold and silver in the first place never went anywhere. They were just being outweighed by one specific temporary force. Body point 3, the part most people miss. Who's still buying? While retail investors have spent the summer watching the price and feeling nervous, the world's central banks have been doing something very different. Buying aggressively. According to the World Gold Council's own data, central banks bought a record 289 tons of gold in the second quarter of this year alone, a 62% jump from the same quarter last year. Poland's central bank led the way, adding 51 tons in that quarter, pushing its total gold reserves past 630 tons as it works toward a publicly stated target of roughly 700 tons. China added another 33 tons in the same quarter, its largest single-quarter addition in nearly 2 years, bringing its official holdings above 2,300 tons. Now, why does that matter to you personally? Central banks aren't buying gold because they're chasing a quick trade. They manage reserves on multi-year, multi-decade timelines, and they buy gold specifically as a hedge against currency risk and geopolitical instability. When the largest, most risk-averse institutional buyers on Earth are adding to gold positions during the exact months the price was falling, that tells you something the retail chart alone doesn't. Professional money used this year's weakness to accumulate, not to run. That's the demand side. Now, let's talk about supply, because this is where silver's story gets genuinely different from gold's and more interesting. Body point 4, silver's supply problem, 7. Silver is currently in its 6th consecutive year of a supply deficit, meaning the world is using more silver than mines are producing, year after year, without a break. Right now, the gold to silver ratio sits near 69 to 1, which is historically a stretched level, one that in past cycles has often preceded stretches where silver outperforms gold, simply because silver tends to be the more reactive, higher beta metal of the two. Part of why this deficit is so stubborn is structural. The majority of the world's silver doesn't come from mines that are digging for silver on purpose. Most of it comes out of the ground as a byproduct of mining copper and zinc. So even when silver prices rise, miners can't simply flip a switch and produce more. Supply is tied to decisions being made in entirely different metal markets. Meanwhile, well over half of all silver produced gets used up permanently in solar panels, electronics, and industrial applications. It doesn't come back into circulation the way jewelry or coins might. That combination, inflexible supply, plus demand that's both monetary and industrial, is why the deficit has run for 6 years straight instead of correcting itself the way commodity shortages usually do. Body point 5. How to tell a real turn from a fake one. This is the part I actually want you to remember, because it's useful every single month going forward, not just this one. Traders have a name for a bounce that fades and rolls right back over. A dead cat bounce. So how do you actually tell the difference between the start of something real and one of those? 1. Watch whether gains hold and build week over week, rather than spiking once and reversing. 2. Watch why the move happened. This move had an actual mechanical cause, easing rate hike fear, not just a single day of random trading. If that trend continues at upcoming Fed meetings, the move has a foundation. 3. Watch silver relative to gold. Because silver tends to be more volatile in both directions, a genuine broad-based recovery often shows silver starting to outperform gold, not lag behind it. 4. Watch the central bank data. The World Gold Council publishes it quarterly. Continued heavy buying, especially from Poland and China, is a sign the long-term accumulation trend is intact, regardless of short-term price noise. Track those 4 things and you'll generally know before the headlines do whether a move like July's is the start of something or just a pause in the decline. Honest risk section. I want to be straight with you because a channel that only ever tells you good news isn't one worth trusting. This turn is early and it's fragile. The Fed hasn't cut rates. It's held them steady while some officials openly push for more tightening. Markets are still pricing meaningful odds of another hike later this year. If the Iran conflict keeps oil prices elevated, or if inflation data comes in hot, that hawkish pressure could return fast, and gold and silver could give back July's gain and then some. One green month on its own proves very little. Nobody, not me, not any analyst, not any bank, can tell you with certainty that the bottom is in. What the data does support is this. The pressure this year has come from one identifiable and potentially temporary source: rate expectations. While the structural demand story, central banks, and the structural supply story, silver's deficit, haven't gone anywhere. So here's the whole picture put together. Gold just posted its first monthly gain in 5 months, driven by a slight easing in fear over further rate hikes. Silver held near $58 through the same stretch, still working through a sixth straight year of supply deficit, with the gold-silver ratio stretched near 69-1. Underneath the daily price swings, the world's central banks bought a record amount of gold last quarter, led by Poland and China, right through the months the price was falling. None of that guarantees where the price goes next. The Fed's next move and the path of the Iran conflict both still matter a lot and could easily push things the other way. But the case that this year's decline was about a temporary rate fear, not a broken story, holds up against the data. Now I want to hear from you. If you've held through this year's drop, what's actually made it hardest to hold on? The price itself or the headlines around it? Tell me in the comments. I read every one. And other people going through the exact same thing right now need to hear that they're not the only ones. If this gave you a clearer, calmer way to look at your own gold or silver, hit subscribe. I'll be backtracking these 4 signals as they develop in the same plain, no hype way. See you in the next one.